In my opinion, dimensional funds are really indeed one of the better funds out there in the market, simply because they have a good track record. They have a very sound investment principle, and thirdly, they are low cost. Take a look at this over here. They've mentioned that they're going to reduce fees and they expect to perform better than broad market indexes and peers after fees. And they are fighting to save each basis points and evaluate the management fees on a regular basis. There are really not many funds out there that reduce their own fees. This is great news to you as an investor. That is why we should deep dive a little bit better on dimensional, and today in particular, let's zoom in on this world allocation 60/40 fund. There are really quite a few choices, but when it comes to someone who is new investing, if you are someone like that, definitely consider something that's more balanced rather than pure equity funds. Why? Simply because when it's balanced, you get more diversified. In terms of volatility, it's less, and ultimately, if you agree or not, your end goal is to reach retirement, your end goal is to reach financial freedom, and get there with less headaches, less problems. That's why we are zooming in on 60/40 fund. It's among my top recommendations for any new investor, and it's a core component of high build portfolios. If you see over here, the representative OCF, the fees at 0.37% per annum is what dimensional charges. Most ETFs actually charge around that range. STI ETF, for example, is one candidate. Most funds actually charge upwards of 1% per annum. So this is definitely low cost. And today, if you're looking to find out a little bit better on what it offers to you in terms of investment exposure, I have all the details for you. Stay tuned for it. Hi guys, welcome back. Let me give you some backdrop as to what dimensional fund actually does in terms of its investment approach, because I mentioned that they have sound investment principles. Dimensional fund is actually founded by Eugene Fama and Kenneth French, and Eugene Fama has actually won a Nobel Prize for it, simply because he's actually found in terms of his research that outperformance comes in when it comes to value investing. Outperformance comes when there's more allocation towards small caps. And that is how dimensional actually approaches his investing, just to narrow description of it in a nutshell. So now let's move on to actually what is this world allocation 60/40 that I promised you upon. 60/40 simply means 60% to equities, 40% to bonds. And you can see over there GBP, ACC. GBP is the British pound, the currency that this fact sheet is actually listed, and ACC is actually accumulation. So when it comes to buying of this fund, if you're in Singapore, look for the Sing dollar one. That's what I suggest for private clients also. And towards the end of the video, I'll leave some links for you. So over here, this fact sheet, we need to take note of the date. This is as of 31st December 2019. That's why the performance that you see over here, it's before the whole pandemic and the whole market crash. So everything has to be adjusted a little bit lower. But I'll show you also on the strong performance, what you see over there, 8.17. Let me circle this over here. You see that since inception, which is in 2011, since inception to 2019, performance is 8.17%. That is pretty good. Most balanced funds actually do not have such performance, and that is why I believe dimensional funds is one of the better ones in the market and one of the top suggestions that I have, especially if you're a new investor. Now let's move on to understanding it a little bit better, and this is the next part of the fact sheet. When it comes to the fact sheet, everything is reported in terms of net performance. That's why, same with dimensional fund, you will see over here that this 8.17 since inception is actually after its annual management charge already. The next part is the index is not available for direct investment. Yes, I work as an independent financial advisor. I can get you access for it. It must be bought through an intermediary. That they believe an advisor has certain value. Advisor can help in terms of coaching, in terms of investment approach. That is things that I've echoed in this committee. And if you haven't subscribed, smash our subscribe button. We're launching videos every week to help you on your financial journey. The next part highlights that the fund is actively managed and is not managed in reference to any benchmark. And the next part also mentioned that past performance does not guarantee future results. Obviously, don't look at 8.17% and assume that it's a smooth path up. It never is the case. 8.17 is over a long period of time, and past performance, we don't know post-pandemic, post-market crash what will look like. But nonetheless, if the investment principles are sound, it just requires time to get good results. And as always, they have also mentioned that guarantees in terms of the strategy is not guaranteed to be successful. Diversification does not assure profit nor guarantees a loss against declining market. As we have seen before in this fund performance, the price actually went down significantly also with the market crash. That's because investment is into equity markets, 60% of it. Now you may be thinking, what room in terms of flexibility does the fund manager have when it comes to this 60/40? This is dug up from actually their annual reports. It's mentioned over here. When they mention 60/40, they have the liberty to move between 40 to 80% in terms of equity allocation. They have also the liberty to move the fixed income between 20 to 60%. 40 to 60 is just a rough guideline in terms of how they allocate, but at certain points they can deviate from there slightly. And this is their approach, and this is actually mentioned in the annual reports. Now let's move on back to the fact sheet itself. You'll see over here that the total number of equity holdings is enormous, 12,932. You know, there's no chance you can buy 12,000 shares at one shot. But when you buy a fund like that, they give you diversification across all regions. Later I'll touch on specifically which region is being overweighted. The next part over here at the bottom is actually the fixed income characteristics. They own 739 bonds itself, which means if a bond defaults, it doesn't really impact the value of the fund too much. And the average maturity is 1.98 years. Now, what is average maturity, you may ask? When it comes to a bond, you know, it matures at some point. It's like a fixed deposit. So a bond has a maturity period. And when we see 1.98% in terms of average maturity, that means that on average, some bonds are even shorter, some bonds are slightly longer. On average, it takes 2 years to mature, which means the strategy currently is short dated, short duration, which means if interest rate change significantly, it's not going to affect the fund too much positively or negatively. So it's really not adversely reactive to interest rate news. On the right hand side, you see calendar year performance. Of course, this looks spectacular because equity performance have been doing well. Take it with a pinch of salt. Only 2018 has seen losses, but the rest of the year is pretty good. Now let's move on to the performance of the fund itself. Over here is mentioned the British pound accumulation, 8 point something percent, and the euro accumulation. Euro one started in 2015. That's why since its inception, it did only 5.22%. The Singapore one only started, I think, a year back only. And the performance is even lower in terms of average basis because it just started with at a not so opportune time. So this actually explains, you know, your starting period ultimately affects your end result. Now after the market crash, perhaps it's a good time to be invested simply because on a relative basis, it's definitely better than in 2019. Now let's move on to understanding, you know, what exactly is in terms of the allocation. I've done research I pulled out for you to quickly see over here. In any case, when it comes to investment policy statement I give to private clients, all this is actually mentioned. Over here, you see the US core equity exposure is the top holding, US core equity 1 and 2, which means they have more than 41% allocated towards US equity. International equities only 11.73%. That means on a relative scale, it invests a lot in US companies. Although US companies are listed there, they have businesses all over the world, and it's the biggest market. In a lot of ways, that is usually the case when it comes to a global fund itself. Your next question may be, what in terms of US core equity is it going into? I have it actually shown for you. Let's pull it up over here. You see that top holdings are Apple, Microsoft, Amazon, Alphabet, Facebook. Brands that you definitely know for sure. Berkshire Hathaway is also on that list itself. Do you remember at the start of the video I mentioned that they have value investing and they have small caps as a core principle. Small caps are definitely not listed in this top 10 simply because when it comes to small cap, they can't put too much into an individual name or so. That's my understanding of how things work. And definitely in terms of comparison to its peers, they have definitely a lot more in terms of small cap allocation. So this part that we will end off is regards to your financial freedom, because ultimately investing is to get you to your financial goals. If you're keen, at the end of the video, I'll leave an invitation for you to reach on a one-to-one basis how you can get started, because as mentioned at the start, this fund is distributed only with intermediaries like myself as an independent advisor. And I want to show you, when it comes to investing, if you can commit towards a long-term investment, you will start to see that compounding pulls up the total returns. You can actually double your money with enough time. How much time? Let's pull this chart over here. You see that if you can invest for 21 years, for example, and you're willing to put in 1,000 a month, what you get at the end of 21 years is 500,000 in pot. This is using a 6% compounding method. Again, just now we've seen the euro allocation, 5.22. The British pound one, which started a bit earlier at 8.17. So on average, if we say 6% in terms of after fees, everything, 6% returns, you can actually reach $500,000, reach your financial goals with 21 years of $1,000. It's not difficult. It's not rocket science. That's why I would like to invite you. Reach me on a one-to-one basis. I would like to help you achieve financial freedom. With that, you can actually retire. With that, we can actually convert a portfolio to dividend-paying structure. There's a lot of things that can be done in terms of decumulating your wealth at a certain point. Because now accumulation is quite simple. What is the best safest way to get there. But next phase is how you can decumulate. And there are strategies that a financial advisor like myself can help you with. So with that, I'll sign off. Again, if you haven't subscribed, smash our subscribe button. If you have questions, leave them in the comment sections. I'll pick up each and every one of them. With that, I'll sign off. Take care and goodbye. If you're looking to get invested, look for links below. I'll be giving you 3 months free in terms of investment management. With that, you get a portfolio that's diversified. With that, you get management and active communication as to what to do with your investments to get to your financial goals. Look for links below. I'll see you there.